All right, Assalamu alaikum, everyone. Hi, all the watchers at home. Thank you for jumping into this interview. We got a brilliant guest today and an amazing topic. We're going to be talking about superannuation, SMSF, and approaching it in a Sharia-compliant Halal way. We'll definitely be talking about property. I know Muslims love property. I personally love property. So we're going to be talking a lot about that. But before we get into all the details, all the value that we're going to drop, let's introduce our guest. Afiq, thanks for jumping on today's episode. Tell us a little bit about yourself, what you do, Granada Wealth, the down low on Afiq Malek.
Assalamu alaikum, everyone. So my name is Afiq Malik. I'm the principal planner for Granada Wealth Advisory. We deal with financial planning and pretty much all holistic advice. Anything to do with investment, we're pretty much the one-stop shop. Obviously, Sharia compliant is our forefront. Yeah, that's Granada in a nutshell.
I feel like that's a very humble introduction. When I think about Afiq, I think about who's going to make me a millionaire and then make me a multi-millionaire. You know what I mean? It's like you're being a bit too humble out here,
Well,
Afiq.
look,
But that's one of the reasons people come to you. You know what I mean?
yeah.
You're clear-headed, you're humble. But no, I'm sure as we get into it, people will see that you're a lot more than that. Tell us a little bit about Granada Wealth. Give us the history. How long have you been, or like your career history? How long have you been in
Of
this
course, of course.
space?
So I like any other person, I started off at the bottom. Back in those days, you were pretty much a connector. You had an advisor that you were dealing with, your mentor, and you're just connecting him to clients. And this was back even before I started financial planning, back in brokering stocks. This was years ago. I'll be showing my age if I tell you how long ago it was. And then being in that industry for about 13, 14 years, I moved from stockbroking to portfolio management and then went down the hedge fund route. So I was trading full time on the trade desk for a huge US firm. Um, and then I wouldn't say I got burnt out, but more I was working a lot of US hours. And, if you're based in Sydney, working US hours is a bit hard. So I had a family and I thought, okay, this is the time for me to pivot out and I pivot into financial planning. I wouldn't say it's easier, but it's more holistic than what I was doing. So before I was chasing a lot of alpha, and now I can just give holistic advice and slowly evolved into Granada Wealth Advisory, and we've been running for a while now, at least 6 years now. But yeah, I've been in the industry for well over 14 years, from stockbrokering to hedge fund management to portfolio management, and now financial planning. And I think this is my space, and we'll be here for a long time there, inshallah.
You have the Wolf of Wall Street, but we have you, the Camel of Halal Street. You know what I'm saying? Or like, I feel like I come up with a better name, but that's all I got for now. But
The
we're gonna have to
camel of
for
Halal
Halal
Street.
Street. we're gonna have to think of a cool
I
name.
think I think we should use lion. The word lion would be
The
good. Oh,
lion,
yeah,
the lion
lion
of
of what?
yeah.
Yeah,
No, I
yeah.
like it. And it's like, personally, I never worked a big corporate. I've always been in small to medium businesses on the ground helping people. But my business partner, Nirvan, he was a lawyer, top four firm, like in a really big position, stuff like that. And one of the points he made, which I feel like is similar to your experiences, when you're over there, it's like you don't really see the application of what you're doing to the people around you. It's like you're working with contracts and you're doing stuff just for like other huge companies, right? And then when you come to this level, it's like, okay, you're actually helping someone that that you can see being someone in your network, and you're making an active difference to their life. Is that an experience you felt like you've had in your transition as well?
Yeah, so as I mentioned earlier, I was chasing alpha. So meaning I got paid by how much we used to beat the market by. So if you didn't beat the market, you didn't get paid, essentially. Well,
That's
you didn't get
good.
your bonus, essentially,
Yeah.
right? But your life is dictated by numbers. You
Yeah.
don't care about the emotion behind it, and you have to be ruthless, right? And
Yeah.
you deal with a lot of doctors, and
Yeah.
I'm sure you deal with a lot of surgeons who are quite ruthless when it comes to things, and we have to be surgical, precision. I mean, everything has to be precise, unemotional when it comes to things, right? And I'm not saying it's not. It's rewarding from a financial point of view, but it's not rewarding from a how am I making a difference in that person's life or the community's life. So Granada does a lot of investments for a lot of charities now. And now we can actually see with the trickle effect. People always talk about trickle down economics, right? But now we can actually see, okay, this amount is actually going to this foundation, and they're building this program for this affected group, for example. And I can see that. And even the advice that we give to clients now, we're not giving a year on year advice. We're giving, how is your life going to look in 10 years' time, 15 years' time, 20 years' time? Can you afford to retire? What decisions you have to make today in order for you to retire, like as you mentioned, a multi-millionaire in 20 years' time? It's very possible, right? And of course, a lot of it we do leverage through properties and other things and other investments. But now, being a financial advisor or financial planner, we take them through a journey. It's never a 1 year relationship. It's not even a generational relation. It's intergenerational. I'm advising grandparents, their kids, and their grandkids on restructuring everything. So it feels good when I go
Building
to.
that generational wealth. And that's something I feel like our community, like, as like a, the Muslim Australian community, it's maturing now. A lot of the first generation, they came from, troubled times, came as refugees or economic migrants, and they were kind of here just to lay the foundation, lay the base. But not a lot of them did well, started businesses, and now their kids are lawyers, doctors. I mean, we were just at Muslim Legal Network here in Sydney. We sponsored their event, right? And it was like so many Muslim lawyers in really top big positions, right? So it's like this next generation, they're now in those higher positions, and we're no longer just surviving, if that makes sense, right?
Yeah.
We're laying now to like this community, right? Like other communities are starting to build that generational wealth.
Yeah,
Right?
it's crazy because growing up, I mean, technically, I'm way past the third, fourth generation in Australia, but a lot of the Muslims are first, second, maybe third generation here. And there's this thing that when I was growing up, when I went to school, I saw all the Muslim. The parents are like, could be doctors, engineers, whatever it may be, builders, whatever it is, right? Business managers, engineer, whatever. But alhamdulillah, we are taking those positions. Like, go to any hospital, right? I mean, I've got clients, and you've got clients who are top surgeons, top doctors. I've got clients who are builders, and they started off hammering nails, and now they're running multi-billion-dollar building companies, right? So the wealth is there. It's just, how do we manage it properly? And that's where I come into place, because our mentality now is changing from the first generation where it's about survival. Now it's more about survival. It's about wealth building, because I can see. I mean, look, there's a stat out there that says that I think it's one of the research houses that show that Muslims are one of the most charitable religions, as in out there, especially in Sydney and Melbourne. They give a lot in charity, a lot, millions. So, but how do we how do you get to that level that your family's happy, you're comfortable, and how do we do more with money that connects to the religion? And our religion says that when we have extra money, we're supposed to do charity work. We're supposed to give to the community, right? We can't bring the money to the akhirah. So how do we financial plan not only for this world, but the next, inshallah? And that's where I think we make the difference at Granada. We sort of cover that aspect. What are we going to do? Do you want to build a waqf for your family, a charity for your family? Do you want to donate this, etc.? How do you have that perpetual system going? But you need to build wealth in order for that to happen. And that's what we do together.
Beautiful. Oh, you're making it deep, bro. As we haven't even got into the meat of the podcast, and you're already hitting on the deep points. Okay,
Well, you gotta be quick, right?
Gotta be quick. You gotta keep the audience engaged. Okay, beautiful. Now that's a good context, right? And I think I agree with everything you're saying. Let's jump into, I guess, the main topic of today, superannuation. So we're going to talk about property, and we're going to talk about SMSFs. I feel like the phenomenon of SMSF is becoming a lot more popular, a lot more accessible to a lot of people. But before we go down that direction, I feel like in our community compared to other communities, and I don't know what the reason is, people don't take superannuation, whether it's SMSF or retail, as seriously, right? What are your thoughts on why that is, and why do we need to take super seriously?
Super is a concept which is not old, but not relatively new either.
Yeah.
So if we talk about the first generation of migrants who first came, super was a very new concept to them, and everybody wanted to do cashies, cash in hand stuff. And then when the government mandated superannuation, everyone thought, oh, you know what? I can only access it when I'm 60 plus. So I don't even know if I'm going to live that long. Because remember, they came from war-torn countries and that hustling mindset, like, I'm just going to do this for my kids. I don't care if I'm dead. So my kids aren't going to get it, which is wrong because your kids can get your super.
They have to get your
They
super.
have to get your
Yeah,
super.
someone's got to inherit it.
Someone's got to inherit it, right? But I think because of that, we sort of don't really care about it. But I think that's a lack of education. But now we're here to educate. That's why we have this podcast on. That education then people realize, oh, there are huge tax incentives for super. And you can actually reap those incentives sooner than you think. And you can actually grow wealth, proper wealth with your super because obviously the tax incentives as well. And you can claim a lot of things with it as well. So I think the education part is an issue, is a factor. I also think that, it's just how we are. But from what I can see now, alhamdulillah, the newer generation, people like us who are a bit slightly older, we're realizing, you know what, super is actually quite important.
You just call me old, bro. What you saying, bro? What you saying, call me
I feel old. I feel old.
Well, you call yourself old, bro. I'm still young, baby. I'm like living life. You know what I mean? Calling me old. I invite you onto a podcast and you call me old.
Older.
Long podcast without that. I'm having a laugh.
So our generation, the slightly older generation, we're finally realizing the actual benefits of having a superannuation. So hopefully that changes and we can actually use that money for the betterment for if not only us, not for yourselves, for your family or the community as well.
Yeah. No, I agree. I think it's kind of like it's almost kind of like a life philosophy, right? I think like a lot of, I guess, other communities, they have the idea that, look, for them, like they see them living a big part of their life at retirement, right? They're going to be like, I'm going to retire when I'm 60 and then I'm going to do all of these things. I'm going to travel, so on and so forth, right? That's one thing. Plus, they're like, also, when I'm at that age, I don't want to be a burden on anyone else, right? So I have to be able to support myself. So they take their super really seriously, right? Whereas for our community, it's one like, oh, we have that, I guess, our relationship to mortality, like, a lot of, we're more like, oh, I could die at any moment, right? And then, so it's like, oh, therefore super doesn't really matter. Plus, it's also like, when I'm 60, my kids are gonna
Look after
they
me.
better be taking care of me,
Yeah.
right? So it's like that incentive to build your super isn't as much, right? But when you take a step back and you look at, okay, you can, especially these days where it's so difficult, it's going to be so difficult for your kids, especially if you're in Sydney. We're filming this in Sydney. I'm personally based in Melbourne. But if you're in Sydney, your kids can't buy a home if they're not a millionaire, right? So it's like you need to, like Sydney, how you need to leave that for the next generation to be able to function. Now that's your kids. Imagine your grandkids want to buy a house, right? It's probably $4 million at that time to buy like an average 500 square meter, like maybe 5-bed, 2-bath house, something like that. I don't even know if I can call that average, right?
Yeah,
So,
the average price in Sydney for a 4-bed, 2-bath house is definitely closer to the 2 million.
yeah, exactly. And now again, depends on which suburb you're at, right? So it's like leaving that generational wealth, right? Like Australia is going to become a lot more, it's only like as individuals, as family groups, as communities, it's going to be much harder to function without generational wealth, right? And like you can already see that happening in Sydney and it's starting to happen in other places. So it's kind of like viewing super as being able to create that generational wealth, right? For your family, for your community. And obviously, ideally, hopefully you live to that age and you can take a decent amount of money and you can enjoy your life. You can put it into projects that you align with and the charities and communities and stuff as well. So I think seeing it as, because at the end of the day, it's mandatory. There is, no matter what you do, money is going to be going into your super if you're on a TFN, right? So might as well optimize that so that it can make as much money as possible.
Yeah, the Australian economy is, I think, from last figures I chose, about 4 point something trillion dollars.
Yeah.
The superannuation industry is worth more than that, $4.7 trillion,
It's
something
insane.
ridiculous,
Yeah.
right? And it's crazy that these industry supers have so much pull with the government because they command so much money,
Mm,
right? So you're looking at the likes of BHP, CBA.
mm,
Your superannuation makes part of that economy which is bigger than them, and
mm,
that's absolutely massive. So if you're not looking at that,
mm,
right, it's wasted money. It's what super is. Super is a future Afiq, a future Arshad
mm,
um, lifestyle, essentially.
mm,
So let's not let it be a future Afiq or future Arshad problem.
mm,
Let it be a future Arshad, future Afiq want,
mm,
or something that we're gonna, okay, this is gonna be awesome for us, right?
mm.
But you can only do that if you start now.
100%.
Yeah.
It's like the starting earlier part, you know, once in a while, and I mentioned this on another podcast recently, but it's so important, right? Like I feel like humans just their brain doesn't fully understand compounding. I don't think like I don't think it's something that our brain fully gets. It's like we're
Mm.
made to live in smaller communities, smaller
Mhm.
villages. The phenomenon of compounding is unnatural to our like conception, right? So what I do every now and then just to remind me how powerful compounding is, I just go jump online, the most basic calculators, not even like a complex calculator, put in some numbers and then you just look at the difference,
Yeah.
right? How much money you're going to make in year 20 compared to year 1, right? And it's like insane. And one of the things I always tell people is if you delay a year, you're not removing year 1, you're removing year 20,
Yeah.
right? Because you're still going to, let's say you're going to live 40 years, right? If you delay it, right? Year 1 will still happen next year, but now you've removed year 40,
Yeah.
right? So it's like, and then when you see how much year 40 is, probably year 40 is worth like $2 million or $1 million or
Yeah.
something like that, right? So understanding the importance of compounding, it'll just make you act now, right? And
Absolutely.
that's super important.
It's never too early to act now,
Beautiful.
especially when it comes to investments,
100%.
whether it be super or outside of super.
Mm,
Now is always the best time.
done.
Yeah.
Let's talk about SMSF, right?
Mhm.
So everyone watching this at home, hopefully that's enough for them to be like, okay, I need to lock in. I need to take my super seriously. I've got 3 different supers. I don't even know whether I need to consolidate them.
Mhm.
I need to think about what I'm investing them in, so on and so forth.
Mhm.
Right? So hopefully everyone's in that headspace now. Let's talk about SMSFs, right? So this is something that so SMSF basically means self-managed super. So when you're a self-managed super fund, so that's when it's not as at a retail, which you'll give a bit more insight on.
Mhm.
But it's an interesting phenomenon because when I first started as a buyer's agent, I feel like self-managed super, the types of people who were inquiring or talking to us about it, it was more like a rich man's game. You know what I mean? Where it's like, okay, I've got like 7, 800, 1 million in my super. Let me start to think about self-managed super.
Mhm.
Whereas these days we're seeing a lot more people. I don't even know if it's a good or bad thing, but we're seeing a lot more people. It's like I've got 200K, I've got 250K, I've got
Mhm.
300K. I want to have a chat about self-managed super. And then obviously we refer them to people like yourselves, to the accountants. But it seems like it's becoming a much more accessible, a much more popular phenomenon.
Yeah.
Give us your thoughts on self-managed super broadly, and what are some of the basic pros and cons of it?
So let's start with the basics of super. So
Mm,
once you start a job, you're, let's say you do, just you're out of high school, just starting a job,
mm,
whether it be down the corner store or whatever. You get yourself, your boss will tell you to fill out a form, and then you're put into an industry super.
mm,
And then from industry super, you can either go straight into SMSF, or you
mm,
can, or the second option is as a wrap platform.
mm,
That's when you can start turbocharging the industry super before you go into an SMSF.
mm,
So the industry super, they'll just put you into a plain vanilla kind of investment,
mm,
7 to 9% on a good year,
mm,
and off you go. Bob's your uncle.
mm, mm,
Now, a self-managed super fund is when you hit a certain threshold with your industry super, and you thought, okay, look, how can I turbocharge my returns properly?
mm,
Now, a self-managed super fund is exactly what it is in the name. So
Mm,
you self-manage your own super fund.
mm,
You literally take your money out from your super, if you're industry super, and get another structure and put your money in there and start managing it yourself.
mm,
Now the question is, what do you put your money in? Now I always say one of the biggest advantage of a self-managed super fund is leverage,
mm,
meaning the ability for you to leverage that against something.
mm,
However, you are limited in what you can leverage it to.
mm.
You can't leverage it into shares. You can't leverage it into buying artwork.
What
You
about
can't,
crypto altcoins?
yeah, crypto coins. You can't do that
You
either.
can't do that.
You can leverage into property, whether it
Mm,
be commercial or residential,
mm,
and that I think is the key
mm,
to turboing or to turboing your returns for your super. And what I mean by that is, it's simple math, right? Let's say you start with $500,000 in your self-managed super fund.
mm,
You can either grow it in your industry super fund for 7% a year,
mm,
or you can borrow against it and leverage into a property
mm,
that might average you 6% a year. But
mm,
if you leverage, you're going to buy a $1.2 million property.
mm,
So if you're $500,000 doing 7% and your $1.2 million doing 6%,
mm,
who's gonna who's gonna win? By simple maths, you know the 1.2 is gonna win
mm.
easily, right? But don't forget, with that
Cash on cash return.
yeah, cash on
That's
cash return
yeah.
is gonna way kill it,
That
right?
that's what you always got to look at,
Yeah.
right? It's not the gross returns on the
Mm.
value of the asset, cash on cash return. I put in 100K at the end of it, how much money am I going to get out?
Yeah. And not only that, tax incentives
Mm,
for purchasing property within your SMSF.
mm,
And the fact that when you do retire and you decide to sell the property, guess what you're paying in terms of tax?
mm,
For CGT, 0%.
mm,
And let's say you don't want to sell the property and you want to get rent instead
mm,
from the property, guess how much you're paying in tax? 0%. So essentially what you're doing is you're building up a lifestyle where you can live off your assets
mm,
tax free.
mm,
And us as Australians, now I'm speaking this as an Australian,
mm,
I don't think paying more to the government
mm,
is. I feel like you probably know how to spend your money better than how the government knows how to spend your
mm,
money,
mm,
right? And I think after all your years of working, you're paying your 30% tax, 40% tax, and you've seen the tax brackets that our clients are on.
mm.
0% tax when you're 60 plus, I'm sure is well deserved. So
Yeah, 100%.
so the reason why you get into SMSF purely for tax reasons and the ability to turbocharge your wealth.
Mm,
That is, I think, one of the biggest cheat codes
mm,
that a lot of people are now just realizing,
mm,
and that's why we're getting this influx of self-managed super fund.
mm,
So ASIC states about $500,000 before you should ever consider a self-managed super fund.
mm,
However, if you've got good advisors like you and I,
mm,
we can push that down to about 200, 250.
mm,
But that there's a lot of factors that come to it.
mm,
It's hard to decide for yourself.
mm,
So that's something that you probably need to chat with one of us to have a chat,
mm.
or me specifically.
Yeah, definitely. I mean,
Or you're a financial planner. It doesn't have to be me
yeah.
or any financial
Nah, bro, it
planner.
has to be you. If you got a financial planner at home, ask him. Nah, I'm joking. There's lots of good financial planners out there,
Yeah.
but our experience with you has been definitely very, very high quality. I definitely think it's something that's always worth having that conversation because there are pros and cons,
Yeah.
right? But if you get it right, you can achieve a lot more,
Mhm.
right? And you can, and again, at the end of the day, it's like if you do it at the right time and you get the right person, right? A retail super, they're retail. It's but in the word itself, they're not thinking about you. They just have like their broader retail investments. They'll put you in a different category, and they'll get hopefully decent performance. But when you're working with a financial planner, they are working for your best interest, right? And they're like ideally, if you're not going to some like huge massive company that just churn and burn, they're like very personalized, right? They'll sit down with you, they'll run you through the strategy, they'll help you think about your risk profile and all of that kind of stuff so that you're not making any mistakes. So you're getting that personalized service which will help you execute your goals a lot better. So no, I agree. I think like it's always worth to have that conversation with the financial planner,
Yeah,
right?
look,
Even if you're like early in the you have like 100K and like maybe you're not going to do it now, but it's like you have that conversation, you're like, okay, I know that I'm going to do this when I'm at X number. I've got this person in my network,
mhm.
right? And when he's told me that once I'm at this stage, come to him. And they might even give you ideas like maybe you should do things like what do you call voluntary contributions or all that kind of stuff, right? So
The
yeah.
way I see it is this, right? Every successful company, just look at your top 500 companies in the world.
Mm,
Everyone has a CFO.
mm.
Financial planners are supposed to be your personal CFOs, right?
Why you so deep, bro? You take
So what we do is we don't become financial planners. I mean CFOs just for you. It's an intergenerational thing,
mm,
and we do it all the time. We see it. How do you maximize your wealth
mm,
for your family? Do you need different structures? You need a
mm,
family trust, right?
mm,
Um, is it, for example, and you've probably seen this as well, is okay, you're a doctor now or you're a mechanic, right?
mm,
It doesn't matter.
mm,
You got a commercial property. How do we maximize that?
mm,
Oh, let's buy your workshop or your clinic through your self-managed super fund,
mm,
right? Because I'm having the same conversations with a surgeon
mm,
and I'm having the same conversations with a mechanic.
mm,
Completely different fields,
mm,
but from a financial point of view, the structures that the advantage that one person is taking is not restrictive to one job.
mm,
It goes all over. I've got um I've got an engineer, a water engineer, right? We bought his office through his self-managed super fund.
mm,
So it's not restrictive. So, if you see your financial advisor, hopefully me, but anyone else,
mm,
we become your CFOs,
mm,
right? You have at minimum
mm,
an annual review.
mm,
I always like to do biannuals minimum for all my clients.
mm,
But then we go through your whole trajectory. What's your family doing? Any significant changes?
mm,
What are the goals? Are we still on track to meet
mm,
those goals?
mm. And
Um,
it's a lot more dynamic as well, right? Like we were at an iftar, what was it, a couple of days ago, and at the time of the filming of this, obviously all this stuff in with America and Iran happened, and you were telling me that that night that it happened, 28th of February, you didn't go to sleep, right? You were like, okay, I need to look at what's happening and see, make sure that our investors are not going to get destroyed by any changes that could potentially come out of this, right? So it's like that proactiveness, right? I think that's super important. Whereas like a retail super, they're not looking at it till that was on a Saturday. They're not looking at it till Monday.
yeah,
Then there's gonna be like 500 layers of bureaucracy, right? And by the time they make an active decision, probably some negative effects of that are felt, right? So
yeah. So
yeah.
Iran got bombed on Sunday.
Mm-hmm,
We made I had an executive meeting with my chief investment officer and my investment team
mm,
Sunday night at
mm,
10 p.m.
mm,
Didn't finish at 12 a.m.
mm.
and positions were changed Monday morning.
Wow, there you
Monday
go.
morning, everything was done, executed by 11 a.m.
Yeah,
Markets open at 9:30.
yeah.
It's 9:30, 10 o'clock. Everything's all executed. We've rotated all our positions purely because something happened. And luckily we didn't, alhamdulillah. All I can say is, as at the time of this recording,
Yeah.
markets are down 3.5% and we're doing okay.
Yeah. So
So,
your clients didn't feel that 3.5% drop
nah, they didn't.
because you were like Sunday night,
Mm,
you're like, you know what? Clients come first,
yeah.
right? So no, and I agree, right? That's why it's like I always tell people when you look for professionals, right? Like I'll take a buyer's agent as an example, right? You don't want to go for that like super small buyer's agency where it's just like one person and they don't really have a team around them because they don't have that leverage and access, right? You don't want to go with a huge company where you're treated as just another number on the list,
Hmm.
right? You want to go with that mid-sized firm, right, where they have a team that operates really well, but all clients still have some level of connection with the top people, the founders. Not to say that the founders are doing everything, right? Like, these days the amount of deals I personally negotiate on are not that many, right?
Hmm.
But I know we have an elite negotiation team, right? And I'm there actively involved in the oversight of each client,
Yeah.
right? Again, because we're literally controlling their life to a certain extent from a financial perspective, right? And that's where that proactiveness
Yeah, because I
becomes.
make sure all my clients have a touch point with a financial advisor,
Yeah.
right? And all those touch points still, some one way or the other, through still go through me.
Mm.
But obviously, I need to sort of let go a bit. But
Yeah.
it just gives that familiarity, if and responsibility. So if anything happens,
Mm.
they know, okay, look, I can get in touch with my financial planner today if
Mm.
I wanted to,
Mm.
right? We've got enough advisors and enough clients that, okay, today, if we can't, let's say something's happened, like a big market movement or something,
Mm.
within 24 hours, we'll be in touch with you.
Really.
So
Beautiful.
that's it. It's always a,
Amazing.
yeah.
Let's talk next about Sharia compliant halal investing in super.
Mm-hmm.
Right. So up until recently, like for me thinking about it from like a property perspective, I guess there's two ways you want to think about it, right? If you're going non-property, you want to make sure the assets you're buying are are compliant,
Mm-hmm.
right? If that's important to you. Let's start off with that and then we'll talk about property. How do you so you're the Muslim clients that you work with that want to make things compliant, what what does that process look like for you and how do you work through that?
So all the investments that we do, we have multiple halal filters or Sharia compliant filters,
Mm-hmm.
and when we run it through, we make sure each and every investment we do is Sharia compliant or follows their standard.
Mm.
Um, we pretty much do all investing that's licensed, meaning, look, we can't deal with property. It's not a product that we deal with because it's unlicensed for a financial advisor.
Mm-hmm.
That's why they go to experts like you.
Mm.
But anything else in the realm of investment, whether it be stocks, ETFs, sukuk/bonds, or fixed income Sharia compliant options, we pretty much cover everything,
Mm.
especially in Australia. So, I mean, look, we do a lot of international investments as well. We have international clients,
Mm.
but within Australia, we pretty much cover everything.
International. Granada's
Man,
international, bro.
going places,
Bro,
son.
international home, bro. I love that, bro. No, that's
Yeah.
okay.
So if we're talking about the super now, look,
Mm.
halal super or Sharia compliant super has a bit of a bad rap
Mm.
in Australia,
Mm.
just with how things have happened and results and fees, etc. I think about 6 years ago, I launched my halal super product, and I run it through a wrap platform, like I mentioned earlier, and alhamdulillah, that's been doing very well.
Mm.
And I think that's how Granada sort of slowly got its name. People just not happy with the current super, they moved over to us,
Mm.
and we sort of grew it for them very, very well. And then we said, okay, look, you've got $350,000 now.
Mm.
Why don't we turn it to a self-managed super fund?
Mm.
So, like I said, we use that as an incubator
Mm.
before we jump it into a self-managed super fund, provided everything else meets its condition, meaning the client's still relatively young, he's happy to take on a bit of leverage, etc., knows the risk, etc.
Makes sense.
Makes
Yeah.
sense, yeah.
It's got to make sense. And I think that point that you made, like there's a bit of a bad rep in this space. Makes sense, right? It's like I guess the fees, there've been some issues around that, but also I think like outside of that, there've been some things that have just been, I guess, like borderline scams, right? Like, I've heard of like stories where, people have just gone and bought like they've collected super from different members in the community and then they've, bought themselves stuff and then they just go buy some like random land in the middle of nowhere and they're like, let's hold this and see how it goes. I think if you're buying something under your super, like this is my personal opinion, it's if someone else is managing it, it should be something you, even if they're managing it, you go with their professional opinion. But I feel like you should at least understand what you're getting into and understand the liquidity of it, especially if you're not the sole owner.
Yeah.
Right. So if you're buying a property and it's just you, right, then okay, awesome. Like ideally it's a good growth property, but you're in complete control of the liquidity of that asset. Right. Whereas if you're going with like, 10 other people or 6 other people, six of you, or you're going, like in one of these funds that are buying land, which is not like a liquid asset and they haven't managed their liquidity properly, it's like, I think that's something to be really careful about because you don't know how your situation might change and access to that liquidity then becomes a massive problem.
Yeah, I agree. So the way I see it is, you need to have a team of experts around you.
Mm.
If you're going to have self-managed super fund, have a financial advisor.
Mm.
If you're going to buy property, have a buyer's agents.
Mm.
and obviously you need an accountant as well, and whoever does your brokering for the
Mm,
finance. You need those people
mm,
to be on the same side as you.
mm,
Don't think having a self-managed super fund is an exercise of, oh, I'll just go and apply it online, do everything myself,
mm,
blah 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 blah. You don't have an investment thesis, you don't
mm,
have a goal, you don't know who's going to help you manage it, etc.
mm,
Especially if you're combining super funds with other parties, whether it's going to be related or not, to
mm,
buy certain properties. Don't You just do your job well.
mm,
If I need my car service, I'll go to a mechanic. If I need
mm,
my teeth pulled out, I'll go to a dentist.
mm,
I'm not gonna do it myself. Technically, I can
mm.
just get something chip out my own tooth,
Yeah.
or go on YouTube and service my own car. But
Mm,
have a team of experts, because
mm,
the way I see it is, you pay peanuts, you get monkeys.
mm.
And if you're serious about wealth creation, you'll realize these advisors are just supposed to help you turbocharge it. So,
Mm.
if anything, go for it.
Yeah, there you go. Okay. Now let's talk about halal Sharia compliant investing in property,
Mhm.
right? So we're seeing a lot of halal Sharia compliant loan products
Mhm.
for SMSF property,
Mm.
whereas it's a fairly new phenomenon, right? Like uh 10, 15 years ago, that wasn't really an option as far as I understand.
Yeah.
Now, we at Pathway Property, we have our own internal Islamic finance brokerage, Sira Finance. If you ever need Islamic finance help, just feel free to reach out. But
Yeah. Now that I see that, there's the Sharia compliant SMSF funding, I don't see a reason for you to say no,
mm,
or there's no hurdle now
mm,
in order for you to turbocharge your superannuation returns,
mm,
because from what I see and from what I understand, even the rates are the same as conventional, if
mm,
not the same. I mean,
mm.
if not maybe one or two
They're quite
basis.
similar,
Yeah, they're
yeah.
quite similar,
One or
right?
two basis
Yeah,
points,
one
yeah,
or two
man.
basis points. It's
Yeah,
nothing, right? And
mm,
remember, you can claim that on your tax anyway.
yeah,
So I think what you guys are doing with, I guess, Sierra Finance is quite well, and purchasing the property and getting them the
mm,
leverage in order to do so. So us as Muslims, we have to be informed,
mm.
and I guess it's one way of us being informed, and hopefully will lead to some decent results.
Yeah, exactly. Because now you have that access, right?
Yeah,
It's like you can buy property under your super
yeah,
using halal financing options, right? And you can do that, right? It didn't back in the day. It didn't used to be an option unless you wanted to
yeah.
go conventional.
I think it only came out like less than 5 years ago.
Yeah,
Yeah, yeah. So
and
no
most people
excuses now.
and most people don't even know about it, right?
Yeah.
Like a lot of the Muslims who are watching, and we know Muslims love property,
Mm.
right? It's like they view it as like a bit more, like it's an asset they own, it's something physical.
Mm.
I don't even think it's just a Muslim thing. I think like ethnics in general,
Mm.
people from Asia major, right? They really like the idea of property ownership, right?
Mm.
And especially here in Australia,
Mm.
Australians love it. Ethnics love it. If you're an Australian ethnic,
You
you're
just buy
gonna
it.
you just buy
Yeah,
it, right?
yeah,
So it's like that accessibility is there now,
yeah.
right? What are some of the risks around buying property in your super?
Oh, there's plenty of risks.
Mm,
The main risk is I think the biggest risk is buying the wrong property.
mm,
That's a huge risk. I've had one client who bought an apartment down in Melbourne
mm,
10 years ago for $430,000.
mm.
She sold it maybe a few months ago for $430,000.
Oh no,
So 10 years, no
yeah,
growth, right?
oh great.
And in self-managed super funds, you want it to be growth because this is going to retire. This is going to fund your retirement. So
Mm.
that's one risk.
Over there, it's like it sounds like she hasn't lost money because she sold it at the same price. But when you take into account inflation,
Mhm.
she's probably lost maybe even half the like
And the
actual
interest that she paid on it as
yeah,
well,
yeah,
right?
the
The
holding
repayments,
costs,
everything,
then the stamp duty, selling costs.
mm,
Everyone's got to have their
share.
bite, right?
So she
So
lost money,
yeah,
right? And for you to lose money in Australia on a property is very hard
mm,
unless you don't get the right advice,
mm,
right?
yeah,
So if you don't get the right advice, you can think, oh, I'll just buy this. No, that's probably the major one.
yeah,
The other one is setting it up correctly. So some people don't know whether they should use a corporate trustee or
mm,
the individual trustee.
mm,
I've seen wrong being set up by the wrong accountant. Some accountants have no experience on how to do that, and they
mm,
didn't get the SOA from a financial advisor.
mm,
ASIC audits them.
mm,
They have to restart the process again. So that $3,000 exercise
mm,
ends up being a $10,000 exercise.
mm,
When if they did it correct in the first place, it would have only cost them $5,000 to $6,000.
mm,
So you know what? Like how people always say, buy once, cry once. That's it, right? So get professional advice. So
100%.
then one of the other things I've seen them do is another risk is not leaving enough liquidity within the SMSF portion.
I think I see a lot of this with like our community, right? And like the subcontinent community. They're like, I'm just going to put all into property.
You can't do that,
Yeah.
because there's diversification rules, right?
Yeah.
But they don't know it. So it's if they get audited, they will get in trouble. And if there anything that needs to happen, might need a new heater or something, water heater. You can't use your own money to fix that. You have to use SMSF money to fix that. So these are certain risks which, if you don't have some guidance, it will really screw up your self-managed super fund.
Let's talk about returns, right? So everyone's talking about superannuation, so on and so forth, investment, right? Now, I'll quickly tell you a little bit about what the returns that we expect when we look at property and what that process is. But I want to understand you just from your perspective, superannuation as a whole, right? Like what sort of, leave out property, just what sort of returns do you have as an expectation for your clients, right? What are the industry averages and what should people be looking for depending on where they're at in life?
Look, I think right now we are in a world where if you have halal super or even halal returns, it shouldn't be worse than conventional. If anything, it should be the same or better. Because my philosophy is it shouldn't only be halal, it should be taib, which is wholesome. And by that, I mean the same or better. So alhamdulillah, your industry average for super is between 7 to 9%, depending on the portfolio and the profile. We've managed to beat that year on year, especially in the last 6 years, easily by 1 or 2%. Last year we did quite well. We beat that by more than 5%.
Amazing.
And
like, I think when people say 5%, it doesn't sound like a big number, right? But if the industry average is 8% and you're at 13%, it's 5% more, but it's around 70%. Like when you look at like the actual cash return, it's 70% more. Right? It's like 5% more of the initial capital, but it's around 70% more in terms of cash on cash return. Right? And then that's the number you need to think about, right? Not because 5% doesn't sound like a big number, right? Like when people are like, oh, 5.
It's close to 50%, or about 43% higher than your average super, which is huge. If you really think
that's
about it,
like if it's like you're getting a 60K or like 100K return on your average super, there's 143K. Right? So it's like 43Ks. And that's not even thinking about the compounding effect. Like literally, if you're at home, just jump online, go to a random calculator, put in starting point $100,000, put 30 years, put 8% and put 12% and look at the difference in terms of the end number. In your mind, like to me, I'm like, okay, the difference is probably going to be around maybe like a few, like, maybe 40, 50K. But like once you actually sit down and you look at the number, you're going to be like, the power of compounding, right?
It could be millions. Genuinely, the difference could be millions. Now, the thing is, people, if you've got higher returns, does that mean you're taking on more risk? Not really. We use something called a wrap platform. And what that means is you own the underlying asset. So when you invest in an industry super fund, you don't own the asset. So the fund owns it and they give you a portion of it because it's a unit pricing. Whereas, if we're investing in things like BHP or gold, etc., you own the underlying. So if there's any dividends, any franking credits, you get everything. So the risk may not, the risk is essentially the same, but the returns are just magnified.
And it's kind of like the same for us, right? I mean, like, I feel like property, it's a bit easier to outperform the market because not everyone's an investor. Most people are buying their own home. But for us, our minimum goal at Pathway Property is the national average. We want to beat that by 75%. So national average is, let's say, 8%, right? Or let's say 10%. We want to be at 17.5. Last year, we beat the national average by 147%. But in all honesty, the last few years for property have been a bit insane, right? So I'm not promising every client, like, Perth, Brisbane, just absolutely.
We'll just put that caveat there. Past results aren't indicative of future results.
But like I tell, like we have that in our office, on our wall, like minimum 75% outperform the market on all assets we buy, especially for the first year, right? That first year of growth, minimum has to outperform the market by 75%. right?
That's really good.
Uh,
Very
and
impressive.
yeah, and it's like I don't think it's as impressive as what you do, because it's like in property, it's actually not as hard to select the right market because
Mm.
not everyone's an investor, right? So you just need to look at the data, see where there's really crazy owner occ demand,
Mm.
where there's underlying fundamentals, and buy in those areas.
Mm.
Whereas when you're buying in like stocks and other assets, every single competitor is an investor, right? So everyone's coming in there with that investment mindset, right?
Yeah.
So it's a lot more competitive.
Mm.
But don't think growth is good enough, right? I meet a lot of people who've made money off of property, right? Older people, right? And they've made money off of property because they invested, not because they invested well, right? They
Mm.
just bought some, okay, I'm just going to go buy some houses. And like 10 years later, it's 600K, now it's 1.2 million.
Yeah.
And good on them,
Yeah.
right? But is that the best they could have achieved? Not by far,
Mm-hmm.
right? Yes, they made 100% in 10 years, awesome. But they could have made like 150%. They could have been like at 4 to 5 properties by now,
Mm-hmm.
right? So even if you're doing something and it's performing well, right, have that constantly reviewed, because it could be performing better. And when you think about that from a compounding perspective, right, 1% per year, right, across 30 years is massive.
Oh,
It's,
absolutely.
yeah.
Yeah, I completely agree. So, and this is why I can't stress the importance of having good advisors, right? Just go out there, have a look around, do your research, and find the right advisor to help you on your journey, because everyone's journey is unique, and no one has a cookie cutter kind of investment thesis or investment journey, and that's why I feel like industry super funds, they just have put you into cookie cutter things. So, do the time, an hour, 2 hours with your advisors will make a world of difference when you're down the road.
Beautiful, beautiful. All right. We've covered a lot. We've talked about why super is important, which is extremely important, right? Number two, we've talked about SMSF. We've talked about property under SMSF. We've talked about the halal financing options for property and for non-property under SMSF. We've talked about why to transition. Right now, one thing you've mentioned quite a few times over here is the importance of a team. Now, I'm going to give you the opportunity. I want to really hear from you about like why people should work with Granada Wealth. But before we do that, tell me leaving out Granada Wealth, what are some of the things people should watch out for with financial planners? Like, how do they, before they identify what's a good financial planner, how do they identify what a bad financial planner is? Give me 2 to 3 things that people should be aware of.
Oh, that's a very good question, actually. I would look at what products they're pushing and how much commission they're getting for the products. There are financial advisors out there who are just commission driven. They'll just push certain products, and then look at if they are driven by funds under management or by profit shares. So there are people out there who are like, yep, I'll get as much funds as I can because I'll just get a certain percentage. Or there are advisors out there who like, look, we're not going to really charge you anything, but if we make money for you, we might charge you a performance fee. So it's within their interest to make sure you grow, because as you grow,
They grow.
they grow, right? And I'd say the last thing is, and I get this often, is when you talk to your financial advisor and you set up their goals, and if the first thing they talk to you is about insurance, I normally would tell them to walk away, because then they just become insurance salesmen, right? Whereas I and my team, we look at what are the goals first. Here's the macro view. Let's break it down to a micro view. How do we get those goals, right? And then of course we'll be compliant, and we make sure everything that we do is disclosed in terms of the fees and everything. And to be compliant, we still have to talk about insurance, but it's not our main goal. Our main goal is to build wealth and hold your hand and be in that relationship throughout the whole time, throughout the whole journey.
Nice.
So yeah, just watch out for those little red flags.
Yeah.
They constantly bang on insurance. They get commissions for certain things, etc.
Yeah.
Yeah.
No, so to summarize, number one was look at the commissions. Number two is look at their model, if it's profit sharing or funds under management. And number three is if they're overly fixated on insurance, then something to worry about, right? I'll add a fourth one to that. And I think this is something I tell people to look for in all of their team members, their buyer's agent, their financial planner, their accountant. look for people who are proactive,
Mm-hmm.
and for people who, when you connect with them, you can feel that they're personally invested in you as a person, right? For me, with all of our clients, because we help them purchase multiple properties, we ideally help them build portfolios. We want to, I want to be personally invested in them as a person. Like, you know, for me, even like one of the philosophies that I have is every client I have, I'd like to at least have one meal with them. You know, just so you can build that personal connection so that I can be like, I'm not just going to go buy this person some random property just so I can get the deal done and move on. It's like, okay, I know this person. I know that they, you know, they have a kid who's studying this. They have an autistic daughter. They've, you know, like this happened in their life. They traveled and, you know, they were all of these things. I know their story, right? And now I'm personally invested in them. Now I don't know how scalable that is, and like sometimes I don't do it for every client. Like, but maybe my business partner will do it. Someone from the business has that connection, right? So it's like find people where you like. My philosophy is find people where you feel like they care about you, and you can see that they're proactive. You don't have to reach out to your accountant and say, "Hey, how's this going? What's happening with this?" They've already told you, right? When something happens overseas, you're not going to call the financial planner and say, "Hey, all of this stuff has happened. What are you going to do?" You wake up Monday morning and there's already an email saying it's already been done,
Yeah.
right? Like that proactive. I think like proactive people is like even like not just this, even like your gym trainer, right? You don't want someone who you're like emailing them and say, "Hey, when is my plan and my diet for next week coming up?" You want them to pick up the phone and be like, "Bro, let's go. You need to hit the gym, lock in time." You know, they push you,
Yeah.
right? Because there's so many things happening in every individual's lives.
Yeah.
If you don't have proactive people, you won't take action,
Yeah.
right? Like I tell all my clients, especially the ones who are really busy business owners, high income doctors, I tell all of them when they're coming on board, I tell them, look, I'm going to be a little bit harsh and I'm going to be your accountability partner. If I can see that you're procrastinating and just, you know, making up excuses not to take action, I'm going to call you out and I'm going to call you and I'm going to tell you to lock in. It's time to start doing stuff, right? And I think like that, those are the type of people you want on your team, people who are going to push you to achieve your potential, not just wait for you to be like, okay, let's do this.
Yeah, that's very interesting because that's what I do with my clients. I set certain goals for them that we have to achieve. We've got 3-month goal, 6-month goal, 12-month goal, etc. Right? And if they don't achieve their goals, and these aren't like you have to climb Mount Everest, for example. It says I know how much they make, I know how much what their expenses are, I know what the disposable income is. Right? We need to invest a certain amount. The way what I always say and the way I always end my meetings with them is this: I'm here to grow your wealth. If you don't follow what we've all agreed on, and you're not growing your wealth year on year, I feel like I'm taking advantage of you and the fees, and I don't want you as a client anymore because it's not ethically right for me, and it's not ethically right for you as well, right? We're not a match. So then, yep, all right, sweet. If you're happy when we're motivated, I'll keep you in check and you keep me in check, right? So I'm here because I don't want to pick up clients who don't want to achieve wealth. As harsh as that may sound, as ironic as that may sound, actually, some clients, you know, they like, oh, really, you're going to put me on blast? Hell yeah, I am, because the more you grow your wealth, the better it is for me and you. But if you're not going to grow your wealth because you're just too lazy or you want to buy Hermes bag every quarter, then it's not going to be a proper partnership.
Yeah, exactly, right? It's like, it's age-old saying, right? You can take the donkey to the water, but you can't make them drink. You want people who are
Oh,
gonna.
I
It
want
is,
them drinking now.
yeah, yeah. You want to. It has to be a partnership,
Yeah.
right? Now, let's finish it off. I want to hear from you. Like we at Pathway Property, you know, like we've helped heaps of clients buy properties, scale their portfolio, stuff like that. And one thing we do for all of our clients, I tell them, you know, it's not even an option. You need to have a chat with our partners. You don't have to use them, but you need to have that chat because you need that context and you need to see what you might not know, right? And we've sent heaps of clients to you and they've all been really happy, right? Tell us what are you doing though when I send someone to you? They come back to me and they're like, "Yo, that guy was so great." Tell us to give us the sales pitch. Why Granada Wealth and why Afiq Malik?
Well, the first thing we talk about is we have a quick chat. When I say quick, about half an hour. We look at your goals and we quickly break down ways on to achieve the goals, right? And sometimes when they do a goal, it's too easy for them.
Mm,
I'll tell them, look, this goal is easy.
mm,
Let's bring it up a bit. Oh, you want to retire with $2 million?
mm,
How about we retire with $3 million?
mm,
How are we going to achieve that?
mm,
Okay, then I'll break it down. And I think people love hearing that these goals are actually attainable
mm,
and can be done quicker than what they thought.
mm,
So they think they might retire in 20 years' time,
mm,
or they won't be able to retire until 20 years' time. We might even scale that to 12 years,
mm,
15 years. We've done that multiple times. And
mm,
I think that's why they're really happy. And of course, we talk about property, etc.
mm,
But we really diversify their portfolio, so they're not really completely just relying on one. We
mm,
talk about how to claim better tax deductions, etc. So I think the fact that Granada does a very holistic approach
mm,
puts us in a different lens than your average financial advisor.
mm. Brilliant, brilliant. Awesome. All right. I think we've covered everything. For those of you who are watching at home, I'd say next steps is reach out, wherever you're at in your journey, it's worth having a chat with the professionals. Reach out to us. We might it might be time for you to move into your SMSF and start thinking about property right now, or it might be something that, hey, that's something down the ways, rather just think about your optimizing your super, and then you can move into SMSF later. Might be about your portfolio outside of SMSF. But yeah, feel free to reach out. I'd say the biggest thing is, even if you're not reaching out to us, reach out to people who can help you think about your next steps, your plan, your strategy. And then honestly, the biggest thing I always see is, I had one of my mentors a while back, and we'll end on this. She's very, very successful. I'm pretty sure her net worth is like 100 million plus, and she came from like pretty much from nothing, right? Like poorer family. She built her businesses, but also built wealth at the same time, investing using the profits. And one of the points she made, and she was saying this more specific to Australia, because I think in other places it might not be as true. But she said, in Australia, the thing that keeps people middle class, it's not lack of knowledge, lack of accessibility, lack of like ideas, it's lack of action,
Yeah.
right? It's like, maybe you're in like a much poorer country, it is actually lack of accessibility or the access to knowledge, right? But in Australia, there's so many good quality professionals available at reasonable prices, and a lot of them will do a free chat with you so that you
Yeah.
can you can have that initial idea, right? So the only thing preventing you from having your retirement at 2 million instead of 4 million is delaying booking that chat, delaying having that conversation, delaying taking action. And I love action takers. I recently had a consult with someone who literally just started their intern year of medical school, and they've been following my content for years, and they were like, Arshad, I just got my first pay slip. I want to sit down. I want to talk about how we're going to make this happen.
Mhm.
Right? Had the chat, and now he's like, he's using his parents as a guarantor. He's going to buy his first property. He's going to, then live in that property possibly and rent out the rooms, right? He's like, and he's going to go into a really high paying specialty. He's like 23. This guy's net worth is going to be like easily 10 mil by his like early 50s, probably even more,
Mhm.
right? But it's purely because he was an action taker. Anyway, thank you everyone for listening in. Afiq, thanks for joining us. Hope to see you on future episodes over here with us at the Pathway Property team. Always really useful insights. And for those at home, thanks for watching. Please dial in again, and feel free to reach out at any time.
Thank you. Thank you for having me.